Chief executives are warning that the U.S. stock market could correct 10 to 15% or more in the next year. That's normal volatility. The real warning is the extreme valuations in the U.S. stock market, especially U.S. growth. We'll take a look at that, but I'll show you where else you could invest, where the risk-reward balance is just better. First, let's take a look at some tables. Here are earnings expectations over the next year for U.S., U.S. growth, and world ex-U.S. small cap value. U.S. and world ex-U.S. small cap value, earnings expectations over 13%. For U.S. growth, it's over 19%. If we look at it over the next 3 to 5 years, we see double-digit earnings expectations for U.S. and U.S. growth. World ex-U.S. small cap value is still robust at 7% expected earnings growth. What matters is what are investors paying for that expected earnings per share growth. And that's where things get a little scary when we see the extreme valuations of U.S. and U.S. growth and more attractive valuations for world ex-U.S. small cap value stocks. Investors are paying over 32 times expected earnings for U.S. growth stocks. This is the forward price to earnings ratio. 23 times expected earnings per share growth for U.S. stocks. Both of those are 2 standard deviations more expensive than long-term average. Now take a look at world ex-U.S. small cap value. Investors are only paying 12 times for expected earnings, and that's less than the long-term average. So yes, the stock market will likely fall over 10% sometime in the next year to 18 months. But now is a prudent time to take some profits in U.S. and U.S. growth, and you can allocate to small cap stocks outside of the U.S. small cap value where earnings will still grow, but there is much less bullishness priced into those stocks, which means in a downturn, they potentially will do better than the U.S. stock market. So what do you think? Is now the time to rebalance and take some profits?